You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, my co-host Sam Ball. This week on The Investor Way, we have Intercontinental Hotels Group, BHP, Mattioli Woods, Admiral, the London Stock Exchange, and our US company of the week is Nvidia. Sam, do you want to kick us off with Intercontinental Hotels Group?
I do. So, Intercontinental Hotels Group, or IHG for the lazier among us, have come out with their half-year results, and total revenue was up 24% to $2.226 billion, and they do give all the figures in dollars. Operating profit was up 62% to $584 million. Basic earnings per share was up 126% to 265.3 cents a share. Interim dividend per share was up 10% to 48.3 cents a share. And the net debt was up 32% to 2.27 billion. They've said that as well as the half-year revenue up 24%, they've had further sequential improvement versus 2019, with Q1 up 6.8% and Q2 up 9.9%. The American revenue per average room was up 11%. Europe, Middle East, Africa and Asia was up 42%, and Greater China was up 94%, reflecting the different levels of travel restrictions that were still in place in the first half last year. The average daily rate was up 7% versus 2022, 11% versus 2019, and the occupancy was up 9 percentage points versus 2022, and just 1.3 percentage points lower than 2019. They opened 21,000 rooms with 108 hotels, and that was 40% more opens than a year ago. And the global estate is now at 925,000 rooms, or 6,227 hotels. They signed 34.2 thousand rooms, and that's 239 hotels, and that's 11% more than a year ago. And their global pipeline is now at 986,000 rooms, or 1,931 hotels. Fee margin is 58.8%, and that's up 3.3 percentage points versus 2022 on trading recovery in Europe, Middle East, Africa and Asia, and Greater China. Net cash from operating activities of $315 million, and that's up from $175 million a year ago, with adjusted free cash flow of $277 million, up from $142 million a year ago. Net debt was up $419 million since the start of the year, including $372 million of share buybacks, $166 million of dividends, and $112 million net foreign exchange adverse impact. There are a few points in the slides. So the leverage ratio is now at 2.3x. The pipeline is 286,000 rooms, and that represents over 30% of the current system size. They have $1 billion of capital to be returned into 2023, and that represents over 8% of the market cap. So that's $1 billion, and that's on basically a £10 billion market cap. So it's about £800 million being returned of capital, which is pretty good. In fact, it's very good. Since 2003, they've returned $15 billion to their shareholders. And what would that be? That'd be about £12.5 billion on a £10 billion market cap. So since 2003, they've returned more than the market cap to shareholders, which is pretty good. I think the share price has probably gone up in that time as well. I mean, in the last 10 years, it's up basically tripled. And on top of that, you've had the whole market cap. I suppose some of that will be reflected in the increase in share price, actually, because a lot of it's through buybacks. So they split their hotels into various categories, but in the essentials category, that includes Holiday Inn, which has 214,491 rooms in 1,193 hotels. And the pipeline is 43,705 rooms, which is 227 hotels. And the pipeline represents 20% of the size. In Holiday Inn Express, they have 330,095 rooms, and that's 3,115 hotels. And the pipeline is 79,283 rooms, which is 640 hotels, and that represents 24% of the system size. In the luxury and lifestyle, that includes the Intercontinental Hotels, which is the world's largest luxury hotel brand. That has 71,487 rooms, which is 215 hotels. And the pipeline is 23,328 rooms, which is 93 hotels. And that is 33% of the system size. And Hotel Indigo, one of their luxury and lifestyle brands, system size 18,916, 145 hotels, pipeline 20,621 rooms, 128 hotels, and that's 109% of the system size. So they are all systems go on the expansion side, it looks like. In terms of valuation, the business, on the back of these earnings, which are massively higher, it now trades at a PE of 21, yields 3.05%, excluding the buybacks, and the market cap's £10 billion. This is a business I think I've been quite critical of in the past, particularly during lockdowns. They bounced back very well. I think the valuation's probably amongst the most reasonable I've seen it. Share price performance is strong as well, actually. So it's up 28% in the last year, 35% in the last 3 years, and 25% in the last 5 years. I think these results, well, there's no knocking it. These results are excellent. That's just a matter of fact, really. We've covered this a few times, and I think I've been fairly critical of it, but there's not really much I can criticize here. I think when you look at the pipeline, I don't think the PE is outrageous, and those returns to shareholders are just fantastic. I don't think it's quite good enough for the watch list yet, but I think I probably have been wrong on this, and I'll probably be watching it a little bit more closely going forward. What are your thoughts on these results and the valuation, John?
I mean, I thought the results were fantastic, and I know we've been harsh on it, as you say, in the past. I think it's easy to tie it up with groups like the Premier Inn, and I think this is a much higher quality business, more capital light, and certainly much better run. The brands are strong within it. And yeah, historically, it's had excellent returns to shareholders, and I don't see why it couldn't continue in that direction, particularly as we're sort of COVID being sort of in the rear view mirror. I think there's a lot going for it, and I appreciate it is more expensive, but I think it's probably reflecting the quality of it in this sector. So probably for the watch list. I can't say I'll be jumping to buy shares straight away, but definitely on my watch list.
Right. Should we move on to a business that once upon a time made it even further than your watch list?
It certainly did. So this is when it was UK listed. It's BHP, the world's biggest miner. Oh, sorry, I should say primary listing. But BHP, the world's biggest miner, and they had their full year results out last week with full year revenue of $53.8 billion, which was down 17% because of lower prices of iron ore, copper, coal, and lower revenue, as well as increased costs, meant that the underlying cash profit, the EBITDA, was down 31% to $28 billion. Free cash flow, including the impact of $5.9 billion spend on acquisitions, was down 77% to $5.6 billion. Net debt rose by $10.8 billion over the financial year to $11.2 billion. Capital expenditure is expected to be around $10 billion this year, and whilst broad-based inflation has eased, costs are still expensive to remain elevated over the coming year. And the final dividend of 80 cents a share was announced with the results. The market was largely flat with these results. And coming to the valuation then, BHP has a market cap of around £115 billion and trades at just 11 times earnings and 3 times forward price to book with a yield of 5.7%. I thought these results, they were to be expected. It's highly cyclical, and a miner is the definition of a cyclical company. I think there are very attractive aspects to the business, and the return on capital employed is pretty high. It's one of the highest in the sector at 28.8% over the year. It's also interesting that it's got the lowest production costs of iron ore from the Australian mine, which does mean that its margins are better than its peers. They've also had a minimum payout ratio of 50% in relation to the dividend, which means that it has been very healthy over the last few years. Although, of course, should the earnings take a dip, as they have, you're going to get a lower payout, but that's fair enough. I did used to own it when it was about £8 a share, and I sold it around 13. And it's been over 20 for most of the year. So it gives a context of how much it had gone up since I sold out. Called the peak too soon. But no, I think it's fairly valued. I don't think it's unreasonable or perhaps even sensible having commodity exposure in your portfolio. I guess it's a question of, do you just want to own the commodities themselves, or do you want to own a company like BHP, which is probably even more volatile? But I think it is a well-run business, and you do get some cracking returns when times are good. So I think I sold out about 2016. It was £8 a share. It's had massive dividends, and the share price is, well, more than doubled since then. So difficult call. I think I know what you're going to say, Sam, but what are your thoughts on these results and BHP as a company?
What's the price to earnings?
11 times earnings.
11. And that's basically on reduced earnings.
It's on reduced earnings, yeah.
I don't know. I think I don't follow commodities at all, really. We talked before about the benefit of having them in the portfolio, and I do agree with that. I agree. I like the diversification of them. That said, I don't follow them at all. So apart from when we periodically cover BHP, I have no idea how they're actually doing price-wise. I'm just very surprised that they're down so much. I know like a lot of the supply problems that we'd had and stuff had eased, but given the inflationary environment, I would not have predicted such a heavy price drop. And it just really shows how little I know about commodities. Some might argue I know just as little about stocks, but yeah,
I suppose there's the demand side of it as well, and less demand from China than has been expected. So I guess depending on how sort of big economies, or some of the biggest economies like China are doing, massively influence the commodities prices, and then therefore the earnings of companies like BHP.
I think if I was going to diversify my portfolio with commodities, firstly, I'd probably just do it pure play commodities or through some kind of index. I know that's arguably not actually a pure play, but I don't want them sat in my house, so I'd probably have to do it through some kind of index. But yeah, it's just, I don't think I could ever hold commodities or anything linked to them in anything other than the long term. I couldn't hold them short to medium term, because how on earth do you predict what they're going to do? I know I can't predict what stock's going to do short to medium term either, but this is just another level. It's just, they're just all over the place. It's just, yeah.
I suppose you might argue, is it sort of fundamentals of the world economy? Are you expecting long-term growth from some of those, big drivers like China? And if you are, then owning a company like BHP, which is the world's biggest miner, with some of those literally, things that are critical to infrastructure, the commodities that they produce, is that, in itself the argument behind holding one?
Possibly. I'd just do a pure play of the commodities, but whichever one I was choosing, I think I would only do it if I was there for the very long term. Yeah, I wouldn't try and time one of these, because
as you saw with me, 6 months I got a return of about 40%. I was like, that's me done. I think Donald Trump had just become president and had announced some sort of massive infrastructure spending in the States. And then there was a big rally. So I thought, I don't know enough about this, but I've got a decent return. I'll sort of, bank my winnings. But I think had I held on, I'd have had a return of about, 2.5 times, 3 times maybe.
Oh, well. Yeah, but you've bought, since then you have bought, I know it's different, but you bought the commodities index. So you have benefited from some of that run up in commodities still.
I know.
You just had it through a different asset.
Yeah.
So you've still got some of the returns you would have got had you held on to BHP.
That's true. And I think actually for my portfolio, as I structure it now, I'm probably happier with the commodities exposure, and probably not with as I would perceive it, some of the additional risks, even though the returns may be better by owning a miner. I think that's probably where I'd sit now. So possibly more risk averse.
You sleep better at night.
I do. Yeah, I do.
That's all that really matters. Right. Shall we move on to Mattioli Woods?
Yes. So a minnow compared with BHP.
It certainly is. So what BHP, what's the market cap for that these days?
About 115 billion or so.
Yeah, this is 300 million. So it's not on the FTSE 250. This is AIM 100. So we did it a few weeks ago and then we went into earnings season, but we've decided rather than cover some random company we're not interested in on a quieter week, we're going to pick a member of the AIM 100 and try and figure a bit about that instead. So this week it's Mattioli Woods, and they, for those who don't know, they are a group of financial advisors. I'll go a bit through the history very briefly. So they were, in 1991, Mattioli Woods Pension Consultants were formed. There's a lot more along the way. I'm just going to cover the highlights. In 1995, they launched the Mattioli Woods SIP. 2003, Mattioli Woods Pension Consultant Limited was incorporated. 2007, Ian Mattioli and Bob Woods jointly won AIM Entrepreneur of the Year, and funds under trusteeship exceeded 1 billion. 2008, turnover exceeded 10 million, which is only about a 1% management fee, isn't it, if they were managing 1 billion the year before. 2012, assets under advice and administration exceeded 3 billion, and turnover exceeded 20 million. I was surprised by how low that was in comparison to the assets. 2014, launch of Custodian REIT on the main market on the London Stock Exchange. I had no idea they were the guys behind Custodian. So I don't own it, but I have looked at it in the past. This is one of the better known REITs, I think, actually. I think years ago, I don't know if it still is, but it was I think it was a Motley Fool recommendation in one of the services. So I think that was how I stumbled across it. 2015, turnover exceeded 30 million and assets under advice and administration reached 6 billion. And 2022, assets under administration exceeded 15 billion. So they've grown quite a lot. However, it looks like the majority of that growth has been through acquisitions, or a lot of it certainly has. Every year that they're acquiring this company, that company, when you go through the history on the website, which is not necessarily anything wrong with that. And then, as well as that, it looks like some of the acquisitions have been dilutive. So they've purchased some of the acquisitions by issuing more shares. So as a shareholder, you've been diluted sometimes. So Mattioli Woods have come out with their full year results. These are actually a month old, but they were recent enough when I decided to take a look at it. So they've come out with full year results, and revenue was up 3% on the prior year, with organic revenue growth of 4%, partially offset by the market impact on ad valorem placement and performance fees. Net client assets totaled 15.3 billion, and that's up from 14.9 billion a year ago, which on a gross basis consists of 11.4 billion of advice and financial planning assets, up from 10.7 billion a year ago. 4.7 billion of gross investment-related assets, down from 5.1 billion, and 7.1 billion of assets under administration, down from 7.2 billion. Gross discretionary assets under management of 4.7 billion, with over 577 million of new inflows in the year. 11.3% of opening assets were offset by negative market movements. They've got a strong financial position with 45 million of cash at 31 May. And they've announced acquisitions of Doherty Pension and Investment Consultancy Limited and 50.1% stake in White Mortgages Limited, although they do have an option on the other 49.9%. Ian Mattioli, Chief Executive, said, "I'm pleased to report further growth in revenue, which is up 3% in the prior year, despite the sustained market and economic complexity that has been a feature of the recent global economy and continues to affect the value of clients' assets. We enjoyed strong growth with our core pension consultancy and employee benefits business segments, with the changes to pensions and tax rules announced in the spring budget driving further client demand for advice, which is partially offset by the market impact on ad valorem fees based on the value of client assets, placement fees and performance fees generated by our Maven private equity business." And in the outlook, he said, "Recent new business development marketing initiatives designed to assist clients in understanding the recent changes to pension and tax rules, such as movements in the annual and lifetime allowance, have both generated increased levels of new business and resulted in a strong increase of 16% in business inquiries versus the last year." In terms of valuation, the business trades at a P ratio of 12.22 and has a dividend yield of 4.42. In terms of the share price, over the last 5 years, the shares are down 29.3%, and in the last year, they're down 12%. And in the last 3 years, they're down 16%. It's interesting, though, because in that time period, the revenue in the last 5 years has almost doubled, which does go to show that, it looks nice, but if it's dilutive, doesn't really matter. The operating profit's down from 5 years ago, as are the earnings per share. So, yeah, it doesn't look like a terrible business, but, if they are a very acquisitive business, I would question why they're paying such a generous dividend. Why aren't they using that money to fund acquisitions? I don't have an issue with an acquisitive strategy, but it doesn't look like it's really, although the business is growing, it doesn't really look like it's increasing earnings per share based on a very surface level overview. It's probably not a business I'd be interested in coming back to. I think if the acquisition strategy was a little bit different and it was being funded out of, say, retained earnings, so it was actually contributing to the earnings per share, I'd maybe feel a bit different. But I think acquisitions are only useful if they increase the earnings for shareholders, really. And acquisition for the sake of acquisition, it just doesn't really, I don't think it really serves anyone. It's not a business I'm particularly interested in any case. Given the sector, it's a very, very tough field. There's some very, very strong competitors. I think it's really hard to give a differentiated product. And a lot of the time, clients will just follow advisors around that they like. It's more about the individual advisors. I don't think clients have any real particular loyalty to the firm. So, it's just nothing in there really that jumps out at me and makes me think I'd want to take another look at this. John, what are your thoughts on the results and the business?
I mean, I'd largely echo what you said, and I think it's another industry that I think people, how willing are they to pay up for some of the advice, especially when there are more things like robo-advisors coming in, low-cost platforms, Vanguard doing a bit of advice. I would worry about all of that if I were looking to buy shares in a very small company, an AIM-listed company like this. Worry about the longer term. And clearly they're growing the revenue, but they're not easily being able to translate that into growing the profits as significantly as you might expect. So it wouldn't be one for me.
And as well, if you're growing the revenue, that's all well and good. But if you're having to issue more shares every year to do it,
and paying out the dividend, I completely agree with you.
Yeah, right. Moving on to a bigger business,
much bigger. Well. Yeah, much bigger. Not quite the scale of BHP, but it's Admiral, which is a UK insurer. 250. In fact, no, it's FTSE 100 listed. It's got a market cap of about 7.5 billion. They had their first half results out, with first half sales up 21% to £2.24 billion, as price hikes across the range of products fed through to higher premiums. Pre-tax profit rose by 4% to £234 million. With gains from the UK insurance more than offsetting losses from the international businesses, though those losses did narrow. Insurance contracts were a little less profitable, with the group's combined ratio rising from 87.1% to 89.8%, measuring the costs versus the premiums, so that being lower, being more profitable. And customer numbers rose 4% as growth in the UK household and international offset a drop in the UK motor division. There was a slight dip in the solvency ratio, with measures of capital levels compared to requirements from 185% to 182%. And there was a total interim dividend actually cut by 15% to 51 pence, which was made up of a normal dividend of 38 pence and a 13 pence special dividend. And shares responded well, unsurprisingly, and they were up about 5% in early trading. I think these were certainly more positive results than we've seen from Admiral in recent years. It's also worth mentioning, and I guess this is kind of part of the investment case for Admiral, is that their business model relies heavily on reinsurance, where an insurer passes on an insurance business to a third party who takes on the liability. It's a fairly common practice, but it does obviously mean that relationships with the reinsurers are very important, but the strategy allows the group to be selective on the risks that it does take. And the group say that they use a lot of machine learning to essentially pick out those more profitable bits whilst not taking on as much risk. And they say that that's helped deliver more market leading performance. Not sure how much knowledge I have specifically on that to say how true it is. The numbers certainly look good at the moment. I think, as we've said many times with some of the banks and the insurers, they are very difficult businesses to understand. And I think to some degree, unless you have an actuarial knowledge of these things, it's tough to make an investment call on them. They're certainly, in terms of valuation, quite pricey at the moment at 17 times forward earnings, I would say, for an insurance company. They do pay out a decent dividend and they're fairly big. It's probably a sector that, with my lack of knowledge and lack of sort of specialist understanding when it comes to insurance, that I probably avoid. And I would also point to that valuation at the moment. It's probably, slightly riskier. Good news is really baked in. And I appreciate these results are good, but they have been really up and down over the last few years. So probably not one for me. Sam, what are your thoughts on these results and Admiral as a company?
Pretty similar. The sales increase is pretty good, but if it's come through price hikes, that's not necessarily a problem, but you do question the sustainability of it. There's not really, I don't think, any brand loyalty. People just switch to the cheapest, so you can only price hike when everyone is price hiking. And the reason that they've price hiked is in the previous year they lost money because of all the inflation and all the increase in car prices compared to what they were factoring in when they'd insured. I think given that the price hikes are, I don't think, sustainable, a forward P of 16.8 is quite high. Appreciate the prospective yield is quite good, but it still wouldn't be enough to tempt me. I think as an industry, it just goes in the too hard pile. When you're talking about stuff like capital levels and solvency ratios, it just very quickly gets to a level of detail that I am uncomfortable with, because there's just this whole other side of risk you need to think about besides the actual looking at the core business and how it does compare to competitors and the brand and all this stuff. So any insurer or bank, really, I'm never really going to be interested in. But, it is interesting to cover. We do like to present the full range of listed stocks on the show for our listeners. But yeah, I would never invest in it anyway. And if I decided I did want an insurer, I don't know why I would pick Admiral over any of the others. They do seem pretty interchangeable.
No, fair enough. Okay, on to a company that's, well, we've heard a few guests on the show mention this in their interviews, the London Stock Exchange Group.
So, yes, London Stock Exchange Group, probably a company that needs no introduction to anyone listening to this podcast, have come out with their interim results, and total income was up 11.9% to 4.179 billion. Adjusted operating profit was up 0.7% to 1.418 billion. Adjusted earnings per share were down 3.9% to 160.9 million. Reported operating profit was down 18.7% to 729 million. And basic earnings per share was down 21.2% to 77.2 million. So total income was up 11.8% on a reported basis. However, on a constant currency basis, it was only 7.9%. And growth accelerated in the second quarter of the half, up to 8.4%. They've said the earnings per share decrease was due to the impact of non-cash FX items and higher effective tax rates. They've updated the leverage target of 1.5 to 2.5x, and that was previously 1 to 2x of operating net debt to adjusted EBITDA. They said that reflects the diversified and recurring nature of the group's revenues. Day-to-day leverage is expected to be around the middle of this range, and no credit rating impact is anticipated. They've said full-year constant currency growth in total income is now expected to be towards the upper end of the 6 to 8% guidance range, and they've had significant shareholder returns, with the interim dividend up 12.6% and 400 million returned via buybacks in the first half, and up to 750 million of directed buybacks expected by April 2024. Now, compared to Intercontinental Hotels Group, these buybacks are much smaller in terms of the percentage of market cap. So 750 million expected by April 24. That's on a market cap of 45 billion. So it's absolutely tiny, basically a rounding error, really. Yeah, so where their adjusted figures are very different to the statutory figures, they have a reconciliation of adjusted operating profit to reported operating profit. So the reported operating profit is 729 million. They've then added back depreciation and impairment of 5 million, added back amortization of 570 million. So that's basically the depreciation on intangible assets. So stuff like, like the Refinitiv IP when they bought that, stuff like that, where they've got to amortize it for accounting purposes. But I think what they're saying is, really, firstly, it's not an actual cost. There's no money going out. But depending on how long you think the value of that brand's expected to be in that asset, it might actually have a far longer shelf life than what is in the accounts and the amount they have to amortize it over. They've then deducted profit on disposal and remeasurement gains, added back integration, separation and restructuring costs, and added back transaction costs. And that gets the adjusted operating profit of 1.4 billion, which is almost twice as high. The bulk of it is, though, the amortization and integration, separation and restructuring costs. There are a few points in the slides. So per segment, data and analytics was up 7.6%, capital markets up 1.5%, and post-trade up 19.2%. And total buybacks from 2022 to April 2024 total 1.5 billion, which again, very small compared to the market cap. And then they've also given total income by geography. So 43% comes from Europe, Middle East and Africa, 42% to the Americas and 15% to Asia. And then total income by currency, 59% to USD, 17% to pound sterling, 16% euro and 8% other. And from 2020 up to the first half of 2023, their recurring subscription revenue as a percentage of total revenue has gone up from 43 to 72%, which probably does add weight to what they were saying about being able to increase the amount of debt because it is far more reliable. In terms of the valuation, business trades at a PE of about 26 and yields 1.31%, and the market cap is 45 billion. I'll just check for that PE, whether it's adjusted. So whether it's adjusted or not makes a big difference. Yeah, so that 26, that's already on the adjusted earnings on the basis. So those adjustments we talked about, if you use them to calculate the earnings, you get a PE of 26. So it's not, I think these results are all right. It's quite a steady grower. I just think for a PE of 26, I would expect it to be growing at more than 6 to 8% a year, especially when that's 6 to 8, that's already on adjusted earnings. Now, I appreciate why those adjustments have been made, but even still, for 26, I would expect a bit more growth. Maybe there's a premium to be paid because the revenue is recurring. It's a very, very high quality business. There's possibly a price at which I'd be interested, but at 26, it's some way off that with the current growth levels. I don't see anything triggering a massive increase either, but it is a pretty good business. John, what are your thoughts on these results and the valuation?
Similarly, I think it is priced for huge growth, very high quality, but we're yet to see it delivering on that, I think. So I'd probably be sitting on the fence with it. It is something that's always on the watch list, but yeah, not right now for me.
Should we move on to a much cheaper business?
Okay, Sam, you joke. So this is one that we have covered before. It's one that I did suggest for the fantasy portfolio back in December 2020.
But had to drop that in then.
it was, I think it was a bit too expensive then too. It's Nvidia, the chip maker. They had their second quarter results out with record revenue of $13.5 billion, which was more than double the same period last year. Performance is being driven by the demand for the group's high-tech chips, which are increasingly being used in AI products. As such, data center revenue was the standout performer with revenue of $10.3 billion, up 171% year on year. Gaming and automotive revenues rose by double-digit percentages, whilst the professional visualization actually declined. Operating profits rose to $6.8 billion, up from $499 million last year. And free cash flow was $6 billion, up from $2.6 billion last year. And there was net cash of $6.3 billion as of the end of July. Revenue for the third quarter is expected to be around $16 billion, which is higher than analysts had previously expected. And the shares were up in early trading nearly 7%. In terms of valuation, Nvidia is ginormous with a market cap of $1.2 trillion, and it trades at an equally eye-watering 45 times forward earnings, doesn't pay a dividend. I mean, I thought these results were incredible. You obviously have had a lot of talk about the future of AI, and that's arguably ramped things up to such a high valuation, although, of course, the numbers are very good. It's also got a very healthy balance sheet in comparison with a lot of tech companies. I think there's a huge amount going for Nvidia, and it does appear to be at the forefront and a front runner when it comes to, if you're buying a play on AI. So incredibly high quality business. I do joke about it when we talk about the fantasy portfolio, but I think if we went back to December 2020, I'd have still had the same concerns about valuation, and it's much easier when you're talking about it with a friend as a part of a fantasy portfolio than paying up, 45 times earnings or similarly highly priced stock to actually pull the trigger with your own money and take a meaningful position in it. I think I would still struggle with that, but I would not bet against Nvidia. It could easily grow into that valuation and keep putting up numbers like this. I don't see a reason why it shouldn't, but if there are any bumps in the road, you'd expect a volatile share price. So it's definitely not one for the faint-hearted. Most of my money, and I know some finds this very boring, is in the world index or the all world index, and these US mega caps, the tech stocks, do account for a decent chunk of that. So I have exposure like that. I'd probably be a bit nervy, I think, paying up for it myself. Sam, what are your thoughts on these numbers and Nvidia?
I mean, the results were fantastic. There's no knocking the results. It's like being transported back in time to 2020 when all the tech stocks were putting up these numbers. But yeah, fantastic results. I think the forward PE, if it keeps putting up these numbers at 45, it's probably justified. But is it going to keep doubling every year? I don't know. And if it has any kind of wobble, it's got a long way to fall. Yeah, I find it really hard with businesses like this because although it's putting up fantastic numbers, it's doing it off such a large base. I would question its ability to keep doing it because eventually the law of large numbers does take effect. And this isn't like, this isn't a Facebook or a Google where the marginal cost, if twice as many people want to pay for Google ads in the next 12 months or Facebook ads, they can do that and there's no marginal cost to them of doing it, really. If twice as many people want to buy Nvidia, they've got to create those chips and all the other stuff. And that is not an easy feat, doubling your business every year. And they do not have anywhere near, I think, the same ability to scale that some of the other tech companies have. Now, I know we've seen Tesla do similar things year on year, but with this kind of business, at this kind of valuation, at this kind of size, I wouldn't touch it. But fantastic business.
Okay, on the companies this week then, what would be your top pick and what would be at the bottom?
I think top pick would probably be Intercontinental Hotels Group. Bottom pick's quite tough, actually. There's no objectively terrible businesses. I'm torn between Nvidia and Admiral. Nvidia on price, Admiral on just it goes in the too hard pile. I'll probably go with Admiral just because there's probably never a price at which I'd buy it because of its industry, whereas there possibly is a price at which I'd buy Nvidia. What about you?
I would go for Intercontinental Hotels Group as my first, and that would be quite an easy pick. And then last, probably Mattioli Woods. It's the industry that it's in. I think it could easily be eaten up, and not with a large buyout.
Okay, I think that's everything then.
Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.